This is part 2 of moving average strategies video. If you did not watch part 1, the link is given in the description of this video. You can go and watch that first and then you can watch this one. So in first part we saw two strategies about how to use moving averages, and in this video we'll cover the remaining two strategies. Well, let me take you directly to the charts. So this is the chart of Nifty of daily time frame, and in last video I observed that 20 moving average was not quite visible because we made it red, and on the black background it was not clearly visible. So this time I have changed its color and made it little bold. So now this is 20 moving average, which is clearly visible, and this is our 50 moving average. This is 50 MA and this one is a 20 MA. Hope you are clearly seeing the moving averages this time. Okay, so our third strategy using moving averages is about pullback trading. Okay, so generally when a stock or index is in momentum or is in, say, bullish momentum, and we want to trade it, then what people do is when it goes up, people wait for it to correct and then enter. Now this strategy is called pullback trading because price went up and you wait for it to correct or come down, and then you make your buying decision. Now what happens generally is when price goes up and it starts coming down, you don't know that how much it will come down, right? Because we are not God, so we don't know till what point it will come. But generally it touches some moving average. It may be 20, in some cases it may be 50, or it may be bigger moving averages also. But generally if you observe now, you observe this chart, what price is doing here in this region, what price is doing. So this is 20 moving average. You are seeing that price is going up, but when price made this high, it is coming and touching 20 moving average. Again price came near 20 moving average here, again price touched 20 moving average here, again price touched 20 moving average here, again it touched here somewhere, right? Now for swing trading, many times what people do is they wait for this pullback and they enter the trade. So they need some reference point to enter the trade. Now in this case, if you can see, 20 moving average is acting as a very good reference, right? So you have to create the strategy where when price is in bullish momentum or in bullish trend, then you should wait for it to correct, and when price comes to 20 moving average, you should enter it, or you can wait for the price to reverse from 20 moving average, and then you can enter. So you can go through different charts of different stocks and see how price behaves in different time frames with the moving averages. You will find that sometimes price respect 20 moving average, sometimes it respects 50 moving average. So you can create your strategy accordingly. This moving averages are very useful for pullback trading. Okay, so even if it is simply equity trading or it is derivatives trading, any trading, you should see the chart, generally the chart of underlying or chart of stock or chart of index, and when it pulls back, what you should do is you should enter, right? So this is one strategy. You can define your exit rules and all that. If price I'll just give you a pointer how to create exit rule. So entry rule I told you that when price touched 20 moving average and then again start resuming its uptrend, you can enter. But then how to exit? You can simply do one thing. When if price closes, if any candle closes below 20 moving average, and if new day candle breaks the previous day low, then you can exit. This is a simple exit rule. So here what we are doing, if like say what happened in this region, one second, like here, okay, what happened here is, say a candle closed below 20 moving average, this is 20 moving average, and this close is below 20 moving average. When this thing happens, next day if price breaks this low, you can exit the trade, right? See, earlier price never broke the previous lows. This even did not close below the 20 moving average. Like that, based on your observation, you can create your rules but you should strictly follow your rules. And before doing all this, when you create the strategy, you should test it. You should test it on at least 10-year data, and then you should see all the statistics, that how frequently it is profitable, how frequently it gave the losses, what is risk reward ratio, what is probability of profit of the strategy, all this. And there are many ratios and many things. What are drawdowns, what is max drawdown, what are continuous number of losers, maximum losers, what is maximum drawdown in terms of money, what is maximum drawdown in terms of time. All these things you have to see, and then you should decide that okay, then I can trade this strategy. But what I am showing you is, this is how you can use moving average when you create your strategy. Now we'll move to the last strategy, and which is again very good strategy. This strategy is not so widely used, but the strategy has excellent potential. But this strategy uses multiple moving averages. Okay, so generally 4 or more. So what we'll do, we already have 2 moving averages. We have 20 moving average and 50 moving average here on chart. We'll add a couple of more moving averages. So we'll add 100 moving average, and then we'll add 200 moving average. So let's first add 100 moving average, uh, okay, I'll make it blue, and I'll make it little faint blue so that it will be clearly visible, and I'll make it little bold, and I'll make it 100. Okay, and the last one will make it a 200-day moving average or 200 period moving average. So I'll make it, say, yellow, because it will be clearly visible then. Okay, so now we have 20 moving average, we have 50 moving average, we have 100 moving average, and we have 200 moving average. So 4 moving average I have added on this chart. Okay, you can select any number based on your back testing and your comfort level. You can use different moving averages. Okay, now let's see in this strategy what you should do. Okay, see here what you are observing, when price is strongly moving upwards, the moving averages are spreading. They're spreading. See, if you see here, if you see in this region, in this particular region, okay, see here moving averages were close. Okay, and then they started spreading, the distance between them started increasing, right? And at this point somewhere their distance between them was too big. So when they start spreading, you should enter the trade. So here at this point of time, let me clear the chart. So at this point of time, somewhere here, you came to know that they started spreading. Okay, and most important thing is the smallest moving average is above all. Then the next one, it's like 20, this is 20, this is 50, this is 100, and this is 200. So they are in this order. If it is an uptrend, they should be in this order, that smallest is up and biggest moving average at down. And if this is the sequence, and if they are spreading, the distance is increasing, right, then you enter the trade. So this will be kind of buy. And when they starts coming together again, now in this region they started coming together, their distance here started decreasing, here you have to exit. So wherever moving averages start spreading and they are in the order, you should enter the trade. And when they start coming together, see here in this region they started coming together, right, their distance started decreasing, they started contracting, they started coming together, there you should exit the trade. This is simple. Now this is Nifty. We'll try to see in the past how it behaved. You also do exercise on many different charts. See here, somewhere at the start of 2017, here in this, here all the moving averages were together, right, they were near to each other. And at this point, after this point, you can see that they are in that order, that is 20 is above, then 50, then 100, and then 200, and their distance started expanding, right. So here there was very less distance and it started expanding. So you have to enter the trade here somewhere, and when they started coming together here, you can exit it somewhere here, because here they started coming together, right? Now you should create very rigid rules for that. You should see many charts, observe how they work, and you should create very clear mathematical rules, okay, based on calculations, that okay, when they start expanding, if this much expansion happens, then enter. If when they are expanded, when they start contracting, when in this region, see, when they all started coming closer, at this point they are very close to each other, right? So you should be able to identify it mathematically and create the system which should just give you signal, oh, now this is exit, now here it is entry. So you can use the expansion of moving averages and contraction as entry and entry signals, and you can create your strategy. We'll try to see some other charts. Let's see Tata Steel. It was of 2019 when it was in downward trend. Recently uh, recently Tata Steel has shown very good up move, right? So its price went up good from approximately 400 to 1000. So see this region, when all moving averages were together, and see where they started expanding, right? So you have to enter it somewhere. You can see, you can mix this or combine this strategy with other things also, that okay, if it is if 52-week high is broken and these are expanding, then I will enter the trade. Like that you can design strategy, or you can add other filters also, based on your comfort, based on your system backtesting and everything. So suppose your system give entry signal here, then you have to just sit in trade and wait, yet you are in trade. So you entered at somewhere around 500 550, and now you are in trade, right? So when all these moving averages will come closer somewhere and your system will give exit signal, you have to exit. That's how it works. Now we'll just try to see one more chart. Let's say Reliance chart. See here somewhere, but not so profitable. You can, but these are if you can apply these strategies in different time frames, okay, but this works best in daily time frame, and you have to wait for long term. You enter and wait for long term, sometimes 1 year 2 year also you wait, you get good profits and you exit. But these work in all time frame. Now say this Reliance chart, and if you see it somewhere here in 2017, then see all four moving averages were together here, right, in this region, and this expansion started. You can apply your other filters also, but when this expansion started, and suppose somewhere here you have entered into trade, if you entered here around say 600 or 640, you entered into trade, and see when it gave you exit, it's like you were in trade for almost 1 year, and here somewhere it came closer. So here somewhere it came closer, so you are exiting after 1 year, and you are approximately earning, it's like 640 to 920, kind of 50% profit. You are just entering and taking 50% profits in 10 months. It's very good. Now immediately after that you get the next signal here. You exited here, and after some time again they start expanding and you enter the trade somewhere here. Right now this did not materialize, price went up, but then it came down and again it came together, so somewhere here you will exit. So you have to create all the rules like this, and you have to test it in different charts and see how it behaves. Like say TCS, this is TCS, say around 2017 2018 you got very good trades, right? You got very good bullish trades, and that is good earning. Say recently also like in September 2020 when this started expanding, and if you enter in a trade somewhere here, then it is almost 50% profit, right? And now it is coming together, so you can design your entry and exit rules like that. Okay, this is a chart of Sun Pharma. See, now this chart is not so clear, so you can avoid taking trade. So, whenever you see very clean charts, then only you should take the trades. I personally do that, and I suggest everybody to do that. See here you can see clear expansion happening and price above all the 52-week high. So somewhere here you can enter and you can exit when your exit criteria satisfies here or somewhere. See earlier also let's kind of say here it started expanding. So in 2012, somewhere in February 2012, you exit the, so you enter the trade around 275 rupees, and you get exit almost at around 600 rupees, more than double within just like 1.5 years. Then again you get the trade and you earn good. So you should keep watching charts for this. This is strategy is simple. When moving averages start expanding, you should enter. When they come together, you should exit. Now this is a general idea. You have to go in detail and form the very clear rules. Otherwise you will have too many entries and too many stop losses hit, right? So when you enter, you should have stop loss also. You can decide your stop loss as if price closes below 200 EMA or 100 EMA, I will exit, something like that. You can put stop loss also, so that you restrict your loss. Okay, so this was 4 strategies, and all these strategies you can use in different time frames. These work in all time frames. Moving average is most used indicator, and it is very helpful because visibly it tells you that what trend it is. And see, you can use this as filter also. If you don't want this as a strategy, if you don't want to use this as a standalone strategy, but you have some strategies which work in bullish market only, then you can put this filter that okay, when all my moving averages are expanding, then this is bullish market. If they are coming closer, that is sideways market. So if such market starts when moving average starts expanding, you can use your bullish strategy. So this can work, or this can be used as a very good filter. When in bearish market, you can use it in reverse order, that when biggest moving average, that is 200 moving average is on top, then 100, then 50, and then 20 moving average is below the all the moving averages, then you can say that this is bearish market. Then you can use your bearish strategies. I guess I'll show you here. See, now here somewhere it started going down, right? So here, say this is 200 moving average, then 100 moving average, then 50 moving average, and then 20 moving average. So here, and they're expanding, and it is bearish, right? So you can use this as a filter, that okay, now in this market I will use my bearish strategy on this stock. So that can act as a very good filter, as a standalone strategy to short in this bearish market, or as a filter. So that's how you can use moving averages. If you have any questions about this, or if you have any suggestions about our videos, then you can comment on this video, because this is a new channel, and we would like to listen from you. If you like our videos, or what you want us to improve, and is the time of videos okay, you want us to reduce it or increase it, or any suggestions, we are open to take any suggestions and your feedback, and your questions. If you have any questions about moving average or anything about trading, you can comment on our videos, and we'll try to solve your queries. So that's all about moving averages. So now I'll conclude this part 2 of moving average strategy series. So please like this video, and subscribe to the Quest for Alpha channel, and let's go on this learning journey together. Thank you very much, and goodbye.